Okay, let's dive into a business that, well, if we're being honest, isn't exactly Silicon Valley glamour. We've got a stack of your sources here, though, digging into Rollins, Inc. You know, the company behind those Orkin vans you see pretty much everywhere.
Right, pest control. It sounds simple, maybe even a little mundane, but what your sources reveal is a fundamentally durable business, almost like a hidden fortress, built on some incredibly strong foundations.
Exactly. Our mission in this deep dive is to unpack this analysis you've pulled together. We want to get a handle on what makes Rollins tick, why the sources describe it as such a high-quality business, and what the absolute key takeaways are for you. It's sort of a masterclass in how a simple idea executed really well over decades can create serious value.
It really is. It addresses a universal, persistent problem. I mean, pests aren't going away, right?
So let's start right there. At its core, what is this business exactly, and how does this fortress idea begin to take shape?
Well, fundamentally, Rollins is a service business. They provide essential pest and termite control globally. Think of it as a route-based model, kind of like the old milkman idea, but, for bugs and rodents, delivered primarily through major brands like Orkin. It's simple, but definitely essential.
Okay. And how does that translate into actual revenue? What does the money flow look like?
So the sources break down their fiscal year 2024 revenues roughly like this. About 45% comes from residential pest control homeowners. Then almost 33% from commercial pest control businesses, another 20% or so from termite services and, related ancillary stuff, and then just a tiny fraction, like 0.5%, from international franchise fees.
Now, something that really jumps out from the sources is the sheer predictability of this revenue. You mentioned over 80% comes from recurring service agreements like quarterly or annual plans. Why is that such a powerful advantage?
Oh, that high percentage of recurring revenue is absolutely the bedrock of their stability. It's almost like an annuity, They have incredible visibility into future income because so much is locked in by contract. This makes the business remarkably resilient, less exposed to economic swings compared to companies relying on one-off sales.
So stable money coming in the door, how do they actually convert that into profit? What are the key drivers for their margins?
Profit is essentially, the spread between what they charge customers and their direct costs. Those costs are mainly the labor for their, over 8,700 technicians, plus the materials they use and their fleet of vehicles. The sources really emphasize that the main levers for profitability are, yes, disciplined pricing, but maybe even more critically, operational leverage.
Operational leverage. Okay, what does that mean in their world? In pest control?
It basically means that as their revenue grows, their profits grow even faster because their costs don't scale up quite as much. And a huge part of how they achieve this, and this is crucial, is through route density.
Route density. Let's dig into that because, the sources say it's absolutely critical.
It really is the operational secret sauce. Just imagine having multiple customers on the same street or maybe in the same office park. A technician can service several locations really close together with minimal travel time, less fuel cost.
Right. Less windshield time.
Exactly. This means each technician can be far more productive, generate more revenue per day with lower expenses per stop. So as they add customers in a specific area, their cost per customer actually go down, and that directly boosts their margins. It creates this virtuous cycle of efficiency.
Got it. So density drives that operational leverage, boosting profit margins. Okay. This brings us to this idea of endurance. The sources suggest this business model is built to last for decades. Why is pest control so resilient?
Well, it really comes down to unyielding human behavior and just basic needs. Pest control isn't a luxury item you cut when times get tough. It addresses fundamental desires for health, safety, sanitation. Pests, they carry diseases, they damage property, and they're a massive reputational risk for businesses, especially anywhere near food service. Like a restaurant absolutely cannot afford an infestation.
Yeah, that makes sense.
As the sources quote, referencing some past leader, rats and roaches have been here for a long time. They'll continue to be here. It's just a permanent problem we have to deal with.
That quote really does nail it. It's just a necessary part of life almost.
And this necessity makes it remarkably recession resistant. Think about the 2008-2009 financial crisis. When tons of businesses saw revenues just plummet, the courses point out that Rollins' commercial side, the business customers, their organic revenue never declined quarter to quarter through that whole period.
Yeah.
That's incredible stability.
Wow. And kind of surprisingly, are there actually long-term trends that seem to help the industry?
Yeah, there are some secular tailwinds, as they call them. Things like increasing urbanization, More people living closer together often means more potential for pest issues, and also climate change, which seems to be expanding the geographic range and the active seasons for various pests. So these big macro trends are generally supportive for demand.
So is the fact that this business isn't exactly, sexy, is that actually an advantage for them?
Absolutely. Its very simplicity, its lack of perceived glamour, it kind of deters disruptive venture capital-backed competition. You don't see anyone trying to build the Uber for roaches, right?
Right.
This lets management focus relentlessly on the core stuff, training good technicians, delivering consistent customer service, and building that absolutely critical route density. It's described in the sources as a slow compounding machine because its value proposition is so elemental, so fundamental, it's just really hard to disrupt.
All right, let's formalize this idea of the fortress then. What are the key defenses, the moat, that protect Rollins' profitability and market position?
So the moat is really built on two main things: powerful, intangible assets and significant cost advantages that come from their scale.
Okay, let's start with the intangible assets.
The Orkin brand. That's the absolute crown jewel. It's been around since 1901. We're talking over a century of being basically synonymous with pest control for many people. That brand equity is incredibly valuable. It significantly lowers their cost of acquiring new customers because people already know the name, they trust the name.
So it gives them a head start.
A huge head start. And it also gives them pricing power. Customers are often willing to pay a bit of a premium for the reliability and reputation associated with Orkin. If you find termites, your first thought might very well be Orkin.
And you mentioned cost advantages. Rollins is, the second largest player in a market with tens of thousands of competitors. How does that sheer size help build the moat?
Well, scale translates directly into cost advantages. Route density is probably the biggest operational benefit, like we talked about. But their size also gives them pretty formidable purchasing power with suppliers for chemicals, equipment, vehicles, all that stuff.
And spreading out fixed costs, too, I'd imagine.
Exactly right. They have substantial fixed costs, things like their big training facilities, developing their own proprietary technology, running national marketing campaigns. A smaller local competitor just can't afford those kinds of investments usually. Or if they can, they have to spread those costs across a much smaller revenue base, making their cost per customer much higher than Rollins. This scale creates a really significant structural cost advantage.
Okay, let's try to see this moat in action. Say I have a pest problem. I call Orkin, and maybe I also call, Main Street Pest Control down the road. How does Rollins Fortress actually play out in that competition?
Okay, well, first off, because of that brand awareness and all the marketing, you're probably more likely to think of calling Orkin first. Then, when the Orkin technician comes out, they might already be servicing, say, 3 other homes or businesses right there on your street or in your neighborhood that same day.
Because of the density.
Exactly. Main Street Pest Control, meanwhile, might have to drive clear across town just for your job. That means Orkin's cost to service you is inherently lower, thanks to that existing density. So they can offer a competitive price, but still maintain a healthier profit margin. Plus, only a scaled player like Rollins can realistically win those massive national contracts, servicing every single location for a big retailer or a restaurant chain. That kind of business is completely out of reach for most local operators.
Yeah, that example makes the route density advantage really concrete. So is this moat just kind of sitting there static, or is it changing over time?
The sources strongly suggest the moat is not only stable, but actually actively widening.
Wow. How does a 100-year-old business manage to widen its moat? That's impressive.
Yeah, it is. They do it a few ways. Their disciplined M&A strategy is a huge driver. They do like 30 to 40 tuck-in acquisitions a year. The sources say they did 44 in 2024 for about $157 million. These are typically smaller local pest control businesses.
Right.
Buying them doesn't just add revenue. It directly adds customers in areas where Rollins already operates. So it immediately increases route density and strengthens those cost advantages in those specific territories. Basically, scale begets more scale and more efficiency.
So the acquisitions are strategically deepening the moat, territory by territory. What else?
Technology. They've invested quite a bit in proprietary tech, things like their BOSS Technician app and something called Virtual Route Manager. This tech helps optimize routing and scheduling, making their technicians more efficient day to day. The sources mention this tech has helped cut mileage per technician by about 5%, which is a direct reduction in fuel costs and time spent driving. That widens the operational efficiency gap against rivals who maybe aren't as tech savvy.
It's interesting how tech enhances what seems like a very human service-based business.
It absolutely does. And, the competitive landscape is also evolving. There was that recent big merger between Rentokil and Terminix, creating an even larger number one player. But that might actually help solidify Orkin's position as the clear, undisputed, leading alternative brand in the customer's mind.
Okay, so it sounds like the self-reinforcing loop. Strong brand gets customers. That builds density. Density lowers costs, increases margins, generates cash flow, which they then reinvest in the brand, technology, and more acquisitions, which attracts more customers and builds even more density. The sources call it a virtuous flywheel.
That flywheel concept really captures the core dynamic, yeah. It's what's driving the widening moat and that long-term compounding effect.
Okay, let's shift gears a bit from the structural advantages to the people running the show. What do the sources tell us about the management team at Rollins?
Well, the leadership seems deeply experienced, mostly from within the company. The current CEO, Jerry Gallhoff Jr., he took over in early 2023. It was part of a planned succession. He actually joined Rollins way back in 2008 through an acquisition himself, and he spent his whole career there moving up through various operational roles, including president and COO, before becoming CEO. So this background gives him really intimate ground-level knowledge of how the business actually works day to day.
And does his philosophy seem to line up with this whole long-term compounding machine idea we've been talking about?
Very much so, it seems. He talks about the business explicitly as a financial compounder, focused on compounded cash flow through both organic growth and those disciplined acquisitions. But he also emphasizes that this compounding is rooted in a people-first, customer-centric mindset. He seems to recognize that the business's real strength comes from its employees and the relationships they build with customers.
That sounds good.
Yeah, and he also speaks with what sounds like a strong sense of stewardship. There's a quote where he says, he feels the weight to leave the company in as good of a shape as I was gifted. That kind of phrase really signals a long-term perspective, something beyond just hitting the next quarter's numbers.
Okay, so how does that philosophy translate into action? Specifically, how do they deploy their cash flow? What's their track record like on capital allocation?
Well, Morningstar gives them an exemplary rating for stewardship, which is pretty high praise in that world. And they seem to have a very clear priority list for using the significant cash flow the business generates. The number one priority is reinvesting back into the business for growth. And as we discussed, the main way they do that is M&A, those disciplined serial acquisitions designed to add density and scale. They spent, $157 million on 44 acquisitions in 2024?
Right.
Capital expenditures, spending on things like tech upgrades or sales infrastructure, those are more modest, about $28 million in 2024, and seem specifically targeted at things that enhance the moat.
Okay, so reinvestment comes first, mainly through M&A and some targeted CapEx. What's next on the priority list?
Shareholder returns. They have a long history of not just paying, but importantly, growing their dividend consistently over time. They paid out almost $300 million, $298 million in dividends in 2024. Share repurchases, buying back their own stock, seem to be more opportunistic. They bought back way less in 2024, only about $11.6 million compared to over $315 million in 2023. That suggests they're pretty price sensitive about buybacks and only do it when they think it's truly the best use of capital versus other options like more M&A.
And does this overall capital allocation strategy make sense logically? Does it pass the rationality test?
Oh yeah, it passes with flying colors according to the sources. They're taking the strong cash flow generated by their efficient, high-margin core business and using it primarily to acquire less efficient competitors. Then they integrate them onto their superior platform and essentially create value by arbitraging their own scale and efficiency. So their capital allocation strategy seems fundamentally aligned with and actually reinforces their core business strategy. It makes perfect sense.
Let's turn to the financial picture itself then. The sources describe Rollins' financial profile as a financial fortress. What does that really tell us? What does that look like?
It basically means the company's financial health is exceptionally strong, very consistent, and incredibly resilient. It's described as a highly reliable earnings machine. They have this amazing track record of consistent revenue and profit growth going back decades.
Any specific numbers that really highlight that consistency and strength?
Absolutely. Over the last 5 years, for instance, revenue has compounded at about 8.4% per year. But their earnings before interest and taxes, EBIT, that grew even faster, at 15.7% annually. That really confirms the positive operational leverage we talked about earlier, profits growing faster than revenue as density increases and they get more efficient.
Okay. And margins.
Their margins are high and remarkably stable. Gross margins are typically in the low 50% range, and operating margins are getting close to 20%. That's pretty strong evidence of their pricing power and the cost advantages coming from that moat.
And what about some of those key quality ratios? How efficiently do they actually use capital and generate cold, hard cash?
Yeah, this is where it gets really impressive. Their return on invested capital, or ROIC, is consistently over 20%. The sources noted it was 20.3% on a trailing 12-month basis recently. I mean, that is an elite figure. It shows they create significant value well above their likely cost of capital.
Okay, 20% plus ROIC. That's strong.
Very strong. And their free cash flow conversion is phenomenal. They consistently convert over 100%, often like 120% or more, of their reported net income into actual free cash flow for the owners. It was around 124% for fiscal 24 and over 130% in the first quarter of 25.
Wow. So they generate more real cash than their accounting profit suggests.
Exactly. That's a sign of extremely high quality earnings and really efficient working capital management. It's pretty rare and very powerful.
And the balance sheet, you said fortress-like.
Yeah, absolutely fortress-like. Their net debt to EBITDA ratio was only around 1.0x at the end of 2023, and it dipped even lower to about 0.8x in early 2025. That is an exceptionally low level of debt for a business of this size and consistency. It gives them a massive safety margin and just immense flexibility whether they want to do more M&A, easily weather any economic storms, or just keep paying out those growing dividends. It's rock solid.
Okay, so recapping. We have a simple, necessary business, a widening moat, experienced and aligned management, rock solid financials. It really does sound like a wonderful company. But here's the million-dollar question, or maybe the billion-dollar question. What price do you actually have to pay for all this quality?
And this is where the analysis becomes a real puzzle, right? The sources are crystal clear on this. This stock has always traded at demanding multiples. And, well, it continues to do so today.
What do those multiples look like right now, roughly?
As of around mid-2025, the sources pegged the stock trading at roughly 57 to 58 times price to earnings, the PE ratio, and somewhere between 42 and 46 times price to free cash flow, PFCF.
Okay, 57 times earnings. 40-something times cash flow. How does that compare to its own history? Is it always this expensive?
They are not only high in absolute terms, like compared to the overall market, but they're also slightly above even their own high historical averages. The 5-year average PE is around 53x, the 10-year is about 51x, and the 10-year average PFCF is right around 44x. So yeah, it's expensive, even compared to its own history of being expensive.
Okay, so given everything we've covered, the quality, the moat, the financials, what's the sort of crucial judgment the sources make about this valuation? Is it just too high?
Well, the sources seem to conclude that the current price is demanding, yes, but potentially a fair entry point for what they see as a truly wonderful company, but with a big caveat, provided you have a multi-decade time horizon.
Okay, so unpack that a bit.
It means it's definitely not a cheap stock in any traditional sense. The market fully appreciates the quality here, no doubt. Investing at this price is essentially a bet that this powerful compounding engine will continue churning out growth in earnings and cash flow significantly enough over a very long period to eventually justify paying this high starting multiple today.
So the high price is maybe a hurdle for achieving like extraordinary returns quickly, but perhaps not a complete showstopper if you're really thinking in terms of decades.
Precisely. The risk of permanent capital loss, the business fundamentally failing and your investment going to zero, that seems exceptionally low based on everything we've discussed.
Right.
The primary risk here feels more like paying a price that limits your future rate of return, not necessarily losing your initial investment entirely because the business itself collapsed. Does that make sense?
Yeah, it does. So what is the single most important engine that needs to keep firing for that growth to continue, to justify that valuation over the long haul?
According to the sources, it really comes down to the continuation of that disciplined M&A roll-up strategy.
Right.
They need to keep successfully buying and integrating smaller players in that still very fragmented global market. Remember, there are over 40,000 competitors out there globally. So there's theoretically a long runway for them to continue executing this strategy.
Yeah, buying those smaller, maybe less efficient operators.
And integrating them into their own more efficient, higher margin system.
Exactly.
It's a proven, repeatable playbook for them. It's historically added, maybe 2-3% to their top line growth each year, on top of what's already a pretty solid organic growth rate of maybe 7-8%. Keeping that M&A engine humming along smoothly seems key to maintaining their overall growth trajectory.
Okay. So despite all this apparent quality and stability, What are the most significant long-term threats? What could actually permanently impair this seemingly strong business model? What keeps management up at night, potentially?
The sources highlight a few key risks. The first one is really a potential failure of that M&A engine we just talked about. If competition for acquisitions heats up significantly, maybe from private equity firms with lots of capital, it could permanently drive up the prices, the multiples they have to pay for these smaller companies.
Right.
This could force Rollins into some difficult choices. Either start overpaying for deals, which would dilute value and hurt their ROIC, or maybe get priced out of the market for the best deals, which would significantly slow down their growth rate and make that current high valuation much harder to justify.
So competition not just for customers, but competition in the acquisition market itself. That's interesting. What else?
Right. A second major risk area is potential damage to the brand and reputation. As a service business dealing with chemicals going into people's homes and businesses, the Orkin brand is, inherently vulnerable. A systemic decline in service quality, or God forbid, a major safety incident involving pesticides, or maybe widespread misconduct by technicians or franchisees, any of those could severely damage the trust they've built, cripple their pricing power, and lead to high customer churn.
That makes total sense. The brand is built on trust and safety, so anything that undermines that is a huge threat.
Definitely. And finally, there's the risk around labor specifically, labor scarcity and cost inflation. They rely heavily on a large workforce of skilled technicians. If it becomes structurally much harder and permanently more expensive to find, train, and retain good technicians, it could force them into a really difficult trade-off.
Like what?
Like, either they compromise on service quality to manage costs, which obviously harms the brand, or they absorb permanently higher labor costs, which directly squeezes their profit margins.
Ish.
Either way, it fundamentally pressures the economic model that's worked so well for them.
Okay, let's step back for a second and try some second-level thinking here. Based on these sources, what's the general market narrative around Rollins? What's the consensus view? And then what might a more contrarian perspective look like?
Well, the market consensus seems pretty clear, and it aligns with a lot of what we've discussed. Rollins is widely seen as a very high-quality, very recession-resistant compounder, durable business, strong moat, good management. The main point of caution, almost universally mentioned in the consensus view, is the valuation. The stock is considered very expensive, trading north of 50 times earnings.
So that leads to...
It leads to mixed analyst ratings, Lots of holds, maybe some cautious buys. Analysts recognize the quality, but they're clearly wary of the high starting price. Their price targets often don't suggest huge near-term upside because of that multiple.
Okay, so the market sees the wonderful business but gets kind of stuck on the high price tag. What's the potential contrarian angle the sources explore? What's the argument against that consensus caution?
The contrarian view, as presented in the sources, essentially argues that the market might be underestimating the true durability and the sheer power of Rollins' compounding engine over the very long term. And consequently, it might be overweighting the perceived risk of that high multiple for a truly patient multi-decade investor.
How so?
The argument goes something like this. For a business with over 80% recurring revenue, elite profitability metrics like that 20% plus ROIC, cash conversion over 120%, plus a fortress balance sheet, the actual risk of permanent loss of capital is extraordinarily low. The business itself is just incredibly robust.
So the idea is maybe the market is too focused on the short-term question of whether the PE multiple might shrink a bit next year, while a truly long-term investor should be much more focused on how much the underlying earnings and cash flow are likely to grow over the next 10, 20, 30 years.
Exactly. That's the core of the contrarian angle. The market might be systematically underappreciating the sheer certainty and the quality of the future cash flows this business is likely to generate, decade after decade. So for a company of this caliber, the contrarian thought is that the greatest risk for a genuine long-term investor might not be paying a high price today, but actually failing to own it at all and missing out entirely on that powerful long-term compounding.
Okay, fascinating tension there. Let's try to synthesize all this. If we were boiling it down for a short investment memo based purely on these sources, what are the core bull and bear cases in a nutshell?
Okay, the bull case would be, it's a highly durable, essential business with massive recurring revenue streams. It has a wide and actively widening economic moat built primarily on the Orkin brand and that critical route density. Financially, it's exceptional elite ROIC, fantastic cash generation, management is experienced, shareholder-oriented, and importantly, there's still a clear multi-decade growth runway ahead, driven mainly by their disciplined M&A roll-up strategy in a very fragmented global market.
Clear bull case and the bear case.
The bear case rests almost entirely on that perpetually high valuation, arguing there's just no traditional margin of safety baked into the price. It points to the key risks: increasing M&A competition, potentially disrupting that key growth engine, or compressing returns. The risk of margin pressure from rising labor or fuel costs if they can't keep pushing prices. And of course, the ever-present vulnerability of the brand to any major service failures or safety issues.
All right, final challenge. Let's do the red team exercise. Let's actively try to poke holes in the strongest parts of that bull case. What's the most powerful scenario you can construct where the bull thesis just doesn't play out, even over the long term?
Okay, the strongest argument against the bull case, the red team challenge, is essentially that the future operating landscape shifts just enough that Rollins' key historical drivers of success, while maybe still present, prove less powerful and more brittle than they have been in the past. The future just doesn't quite rhyme with the past.
Walk us through what that difficult scenario might look like.
Well, the challenge scenario might assume that, say, private equity capital permanently alters the M&A landscape for pest control businesses. It drives acquisition multiples up to a point where integrating these smaller companies just no longer generates those attractive high returns on invested capital that Rollins has historically enjoyed.
Okay.
This forces management into a tough spot. Either they start overpaying for deals just to keep the growth engine going, which obviously destroys value over time, or they have to significantly slow down the pace of M&A, maybe focus only on organic growth, which cuts off a major historical source of their overall growth.
So the primary growth engine kind of sputters because the acquisition economics just aren't as good anymore. What else goes wrong in this challenging scenario?
Well, maybe simultaneously, customer tolerance for continued price increases starts to stiffen, perhaps because of cumulative past increases, or maybe increased competition finally starts to bite harder on pricing. And at the same time, let's say the labor market tightens permanently, leading to sustained high wage inflation that Rollins finds they just can't fully offset anymore through pricing hikes or efficiency gains alone.
Okay, so caught between a sputtering M&A engine, maybe more limited pricing power, and persistently rising labor costs, what's the ultimate outcome for the business in that scenario?
The outcome is that earnings growth decelerates significantly. Maybe it drops from the historical low double digits down to something more like mid-single digits annually. Margins might compress a bit, or perhaps they just stop expanding. The business is still good, right? It's still stable, generates cash, serves a necessary need, but it is no longer the exceptional high-growth compounder that the market had priced it as for years.
And what likely happens to the stock price in that scenario?
Well, recognizing this fundamental shift in the future growth and profitability potential, the market eventually reprices the stock. That really high PE multiple, say 50x or higher, it collapses down to a level that's more appropriate for a steady but slower mid-single-digit grower, maybe something like 25x or 30x earnings.
And for someone who bought in at the high multiple?
For someone who bought the stock near the peak multiple, this severe multiple compression could easily wipe out years, maybe many years, of the now slower underlying earnings growth. The stock becomes dead money for a long time, or could potentially even result in a capital loss, despite the underlying business itself not actually failing. The crucial mistake in this red team scenario was paying that premium price for exceptionalism, exceptional growth, exceptional profitability that the changing competitive and operating environment could no longer fully support going forward.
Yeah, that really clarifies the core risk, doesn't it? You're not just paying for the quality that exists today, you're implicitly paying for the continuation of that exceptional compounding into the future.
Exactly. It perfectly highlights that tension between owning a truly wonderful business and grappling with a potentially challenging starting valuation, particularly if some of those key future drivers don't quite perform as strongly as they have in the past.
Okay, well, we've gone pretty deep on this one. We've unpacked what seems like a simple business addressing a permanent problem, looked at the widening moat, the management, the stellar financials, the risks, and that central valuation challenge.
Yeah, we've seen it's a business protected by what looks like a powerful, expanding fortress built on the Orkin brand and route density. It seems to be run by experienced hands, and the balance sheet looks like a model of strength.
But we've also definitely wrestled with that perpetually high price tag that really seems to be the central puzzle piece here for any potential investor.
Absolutely. The core challenge the sources present seems to remain. Is this truly a wonderful business trading at a merely demanding and therefore potentially fair price for someone embarking on a genuine multi-decade compounding journey? Or is it actually a great business, but one that's priced for a level of perfection that might not fully materialize if those key dynamics, particularly around M&A returns and continued margin expansion, shift even slightly against it in the coming years?
So thinking about that red team challenge, we just discussed that scenario where the future drivers prove maybe a bit less powerful than the past ones. What kind of risk should a truly long-term investor worry about the most when looking at a company like Rollins? Is the primary concern the risk of the stock's valuation multiple contracting significantly, or is it the risk of some kind of permanent damage occurring to the underlying business model's ability to compound earnings effectively over time? Something for you to ponder as you digest this deep dive into Rollins.